Hey guys, my name's Nick Oliver. I'm a financial analyst here at EAP, and I'm here today to talk to you about financial modeling and why it's important for your submission for this pitch competition. So financial modeling is what we like to call an abstract representation of a real-world financial situation. And why do you need to know about that? Well, the financial model is one of the two key elements that you use when you're kind of presenting an idea to a potential investor or a bank partner or something like that. And the two are the pitch deck, which we'll discuss, and the financial model. The financial model is important because really it's a summation of all the variables that go into your business making money. So think about how you're going to make the money and then the costs that are going to come out of that money that you make from selling your product, selling your service, or promoting your business. So what is a financial model used for? It's used for a host of things, but the most important ones are fundraising, growing your business, budgeting and forecasting the future of your business, valuing your business, and part of valuing your business is partnering with a person that wants to maybe buy your business from you if you ever look to sell it, or value the assets on your balance sheet. And we use that a lot with the clients that we serve because they have to understand that there are real-world costs that go into their business. And just because an idea is very creative or cutting edge, if the economics of the deal don't make sense, if it costs $1 to make $1 and you can't make any money from it, that's going to impact the legitimacy of the idea. So within financial modeling, we focus on three important financial statements. That's your income statement, or your P&L, is profit and loss statement, which is what some people call it, your cash flow statement, and finally your balance sheet. And these are the three financial statements that are universally recognized as what are considered financial statements. And we're going to walk through each one and walk through why they're all important. So when you begin to think about your income statement, which is just looking at your revenue minus your expenses to get to what you make, you want to start creating startup costs and think about how those are going to play into your day-to-day income statement. And we like to separate startup costs into two categories: a pre-launch startup cost and a survival period startup cost. Pre-launch, this is everything that you're going to have to go through to get started. So if you have to pay money to incorporate your business with the Secretary of State, if you have to get permits to operate your business in a certain area of town, if you have to buy equipment, if you have to hire people, if you have to travel to different areas to establish contracts with suppliers, really anything that's going to be necessary to get your business off the ground and to hang a shingle on the wall and get your business going. That's what we consider pre-launch startup costs. The opposite side of the equation for your startup costs is what we call survival period startup costs. So once your business is up and running, you've gotten all your pre-opening costs done, you're ready to go, and you're operational, but you may not have any customers, you're still going to incur costs, whether those are utilities from keeping the lights on at your office, whether that's insurance to cover your employees, whether that's the cost of inventory that you have to purchase in order to sell your actual goods. You're going to incur some costs regardless of whether you actually make any sales over a brief period of time. And we like to think about that time period as 1 to 3 years. So if you didn't make any money in 1 to 3 years, but you still wanted to remain operational, what are the costs that you're going to incur on a month-to-month basis that you're going to see regardless of whether you get customers? And that's what we call your survival period costs. So when you think about those two things, think about what your startup costs are and combine the survival period costs and the pre-launch costs to get to your total raise. And that is factored in to your income statement. So obviously when you look at an income statement, you're focused on how much money can I make from selling one widget of my product. So say you create a video game that you sell for $55. If it costs $40 to make that, then you're going to make $15. And so that's kind of what we look at when we talk about an income statement. An income statement is your top line revenue. So if you sell 100 widgets at $1 a piece, you make $100. if your cost of goods sold on those pieces of equipment or in those widgets is 30 cents, you have to subtract that out of the total revenue. And then if you have to pay people, if you have to market, if you have to take on contracts to sell more of those products, that's all going to be costs that are going to be factored out of your revenue to get to a profit and loss statement. The balance sheet is your assets and your liabilities, and then you back into your equity or your ownership of the company. And your assets are anything that you use to create your products or create your business. And think about this as like inventory that you hold, cash that you have in your business, physical real estate. If you own property, that's definitely an asset. And the liabilities are the opposite side of that. Anything that you owe money on, whether it's accounts payable or long-term debt from the financing of a piece of real estate or a building, that's your balance sheet. And the difference between those, your assets minus your liabilities, equals your equity. And a lot of people think of this as the ownership that they have in the entity or the company. So if your assets are $3 million and you got liabilities of $2 million, you have $1 million worth of money to you as a business owner in that business. And the cash flow statement, finally, is kind of one of the statements that some people get a little confused by, but that's okay. It's not too difficult. Really, the cash flow is the money going in to the company versus the money leaving the company on a day-to-day basis. And not to get too far in the weeds, but there are some certain non-cash expenses like depreciation that can actually be added back in to see what the actual cash flow of the business is. And if you were to ever get into the value of a company, a lot of times analysts value a company based on the cash flow or the EBITDA, or earnings before interest, taxes, depreciation, and amortization, because it's a good barometer for the value of the company. So that's beyond the scope of this course, but remember the three financial statements that you need to have are the income statement, the profit and loss statement, the cash flow statement, and the balance sheet. And we're going to have templates for all of these online, so don't worry about understanding every nuance of that. It'll be explained to you in the deliverables that we give you. So let's talk about sources of capital. So obviously, if you're starting a business, you may need to go out and find some money to get started. You may not personally have the amount of money necessary to start a business. And we're going to talk about various different ways to get that capital today. So the most notable one that people think of probably when they first think about starting a business is just self-financing it, right? So if you don't have a lot of expenses that you have to cover up front to get started and to get your business going, think about if you were to open up like an e-commerce store. All you really have to pay for is maybe a website, some inventory so that you can sell your product day one, and maybe a social media profile. That's not a lot of upfront costs. So that's something that you could self-finance, or what we call bootstrap. So if you're an entrepreneur that doesn't have a lot of capital that goes into starting their business, you can possibly self-finance it. And that's a lot of people's businesses. A lot of small businesses or mom and pop shops start off as self-financing or bootstrapping because at the end of the day, you don't have to take on debt and you own 100% of your company. So a lot of people like that. The next one is what we call family and friends. So if you have to raise more money than you personally have at your disposal, the first people you probably will talk to are your family and your friends. So your mom, your dad, your grandmother, your grandfather, people that are close to you who believe in you as an entrepreneur will more than likely be willing to contribute to help you fulfill your dream of starting a business. And a lot of times, the terms that they require, because they're close to you and because they love you and they care about you, will be friendlier than an investor or a bank that may not know you and may not know how passionate you are about this business. So sources of capital, we definitely factor in family and friends. That's normally the first round of financing beyond self-financing. The next one is what a lot of people think of when they think of starting a business, and that's walking into a bank and asking for a loan. So we call commercial loans or bank loans or SBA, they all fall under taking on debt from a bank. So this is what you see in movies and TV shows. If you want to start a bakery, you go to a bank and you say, hey, I want to start a bakery and put it on Main Street and sell my goods. And the bank is going to say, okay, well, why should we take that risk on you? I mean, how are you going to prove yourself? And a lot of times banks are more conservative in their risk tolerance, so they'll require something called collateral. Collateral is just something that you are willing to give up in order to receive the money that the bank wants to give you. So most of the time that's real estate, so a piece of land or a building that you may own that they'll take in order to give you the money necessary to start your business. And they have a whole different process for how they go about underwriting a deal and making sure that it's good for them, because ultimately the bank has to be sure that you're going to pay your money back so that they can give you the loan and make the interest on that loan. So one that a lot of people aren't familiar with are state and local lending programs. In Louisiana, most notably the LIFT Fund and the SEBD program, the Small and Emerging Business Development Program. And there's actually capital out there and money out there for people starting certain businesses. So if you're not familiar with that, go check out those websites, go check out the resources that those guys provide, the LIFT Fund and the Small and Emerging Business Development Program. So I don't work with those a lot of times, so I'm not super familiar with them, but check them out. They may be a good source for you. What we deal with mostly at EAP is what we call private investors. So private investors are a business professional or someone else in the community who gives money to people starting a business in turn for that entrepreneur giving them partial ownership in that company. So angel investors, family offices, for more sophisticated deals, private equity or investment banks, these are what we consider private investors. So they are more than willing to give their money to an idea that they believe in and an entrepreneur that they believe in, but you have to negotiate terms for those investments. So maybe if I have an idea to start a software company that's really innovative and new, but I need $1 million, I'll go to an angel investor and say, hey, I need this money, this is my idea, let me realize my dream of starting this software company. And that angel investor will say, okay, well, I believe in you, this is a great investment idea, I think this is a new product that could be innovative, but I need to get my cut. So maybe we'll negotiate back and forth and I'll give up 30% of my company or 15% of my company for that investment. So that's a negotiation between you and a potential investor, which can be very lucrative, and because those investors and family offices a lot of the time have expertise beyond what you have. So they've seen a lot of deals, they've seen what works, they've seen what doesn't work, and they can be a very good mentor and a good source of guidance for you as you start a company. So it's not just money, they also can provide expertise or help in starting your business that you may not have even known that you needed. The next source of capital we'll talk about is what are called venture capitalists. And these are the guys beyond family offices, beyond angel investors, that are what we would consider as institutional money. So they're smart money at the table. They invest in big deals. So these are the guys that invest in companies like Uber and Airbnb and Slack and companies like that have proven their business model on a small scale, but they need exponential growth capabilities. And the only way that they can get that is with large infusions of capital, large infusions of money that they get from venture capitalists. So again, the negotiation goes back and forth similar to angel investors, but on a bigger scale. You're valuing your company. You're saying, okay, I maybe need $20 million, and I'm going to give up 5% of my company. Because at this time, if the business model is proven, that company is worth more money. So you're able to negotiate a better deal for you as an entrepreneur to get more money for giving up less of your company. So venture capitalists are another source of capital. Finally, there's grants, which we would consider non-dilutive capital. So grants are anything from a government entity or a national accredited foundation that they may grant money out to a company in order to pursue certain goals, whether it's in the medical field or the education space or something like that. There are funds out there that entities will give to entrepreneurs and give to companies to realize their idea, and they don't have to give up any ownership for them, and they don't even have to pay them back. So we love grants, and entrepreneurs love grants because they're typically mission-minded, and when you win a grant, you have a specific purpose with which you have to deploy that cash. And we love it because entrepreneurs don't have to give up any ownership in the company. So they're not diluted. They still own 100% of their company, and they still have the capital that they need to get going. And finally, what we don't see a ton of but has grown in the past few years is crowdfunding. So these are Kickstarter, Indiegogo, the online spaces where you can contribute small amounts of money to an idea that you believe in, and it'll directly improve the likelihood of that product or service being a success. So I'm sure you've seen a campaign on a crowdfunding platform go viral. They happen every now and then, and it's a great way to use network effects and get a lot of people to see something. And even if it's $10 or $20, but it doesn't seem like much, but if you get 100,000 people to do that, that's a huge source of capital that you can use to grow your business. So finally, now that we've talked about the financial statements, we've talked about sources of capital, we'll talk about why this is all important and kind of wrap it up before D'Angelo gets up here to talk about marketing. So why is this important? Why is knowing how much money you need important to the success of your business? Well, some of the top reasons why startups fail is that they just simply run out of cash. Their idea might be great, their team might be great, their execution capabilities may be fantastic, but if they don't have the capital necessary, then it's not going to work, because you can't pay your vendors, you can't pay your employees, and you can't do what's necessary to get the revenue in the door to make your business a success. So what we call undercapitalizing your company is when you don't raise enough money. That can be deadly for your enterprise. So be sure you know how much money you need, and even err on the side of caution and say, okay, if I need $100,000, maybe it's a good idea for me to maybe it's good for me to build in a cushion of, say, 25%. So maybe I need $125,000. So you know that you won't run out of cash, and that won't be the reason that you don't make it. So let's bring it all back for your competition specifically, what we're going to ask of you. So the most notable thing we're going to ask of you is estimating your pre-launch costs. So this is your startup costs. And remember, it's all the things that you need to get going before your business gets off the ground. So permitting, inventory, buying a building, or securing a lease, or something like that. Estimate your pre-launch costs. The next thing is your project expenses. So remember, we talked about the startup costs and the survival period costs. Your project expenses make up that survival period cost. So how much do you need if you're not making any money to keep the doors open so that hopefully your business can take off? You also have to be able to project revenue. So we have to be able to say, okay, if we can grow our business at 10% a quarter for 3 quarters, where are we going to be at the end of 3 years? So if you know you're going to sell your widget for $10, how many of those do you have to sell in order for your business to make money based on your projected expenses and your projected startup costs? So how long is it going to take you to break even? Is it going to be a year? Is it going to be 5 years? Are you never going to break even? These are important things that you need to know to communicate to your potential investor how your business is going to be successful. And finally, of the 8 sources of capital that I just explained to you, select 1 to 3 of those sources of capital that you think would be appropriate for your business and most advantageous to you as an entrepreneur. And these templates are, like I mentioned earlier, they're going to be provided to you. They're going to be provided to you within the confines of this competition, so be on the lookout for those. And with that said, I'm going to move it on to D'Angelo, who's going to talk to you about marketing.